Good afternoon. Investment properties on sale. Let's assume for a moment that we have a crystal ball and we believe the numbers are going to go down. What does this mean? Today we're looking at investment properties. There's a variety of different points we need to look at, but fundamentally when it comes to investments, if the price goes down, then your cap rate goes up. What is a cap rate? Cap rate is a percentage return, positive or negative, of course. You've heard of stock dividends. If you're comparing investments or cash flow, let's say, you're going to compare a cap rate of a piece of investment real estate to dividend percentage of a stock or business or whatever you're looking at. In this case, we're talking about cap rates, which is the reference point to real estate return. And what a cap rate is the net income or loss divided by the purchase price. We'll give you a percentage and that is your cap rate. I'm gonna go into a few numbers here. And I know Ben went into the numbers last week. I don't typically like to do that because it's hard to follow, it's a little tedious, but this is a way to really emphasize the easiest way to do that. So 2 months ago, we sold a property, a condo for $625,000. Rental return on this condo was $2,200 a month. How are we deciding this cap rate and if this is a good investment piece of real estate to buy or if it's not? And that's always a personal preference if it is or isn't. If you're specifically looking for cash flow, that's going to send you down one road. Looking to hold a piece of real estate with a tenant in it and wait for capital appreciation, that's another avenue of investing. It's totally up to you which way you're looking at the piece of real estate. Today, of course, we're talking about the cash flow return, positive, negative. So just as a side note, the mortgage qualification details that I've used here is 25-year mortgage at a 5-year fixed rate term at 3.74%. The piece of real estate is $625,000 in Mount Pleasant, Vancouver, 2 months ago. It's a 1-bedroom unit and the rental return on that is $2,200 a month, which he just secured. So that's relative as well. Strata fees, $270 a month. Taxes, $1,450 a year, which is $120 a month. So on $625,000 purchase price, put down 20%, that's $125,000. That works out to $2,560 a month for your mortgage. 20% down, so there's no insurance, not a high ratio mortgage. You add on the monthly property tax and the monthly for the strata fee, and your total is $2,950. So you're paying $2,950 to own it, getting $2,200 rent. Disconnect is $750 a month, monthly loss per month. Obviously. That's the first very common scenario that I'm seeing in Vancouver. The biggest problem with Vancouver is the pricing is so high relative to the rents that it's extremely difficult to get a break even or a positive cash flowing piece of real estate unless you're putting a large amount down, which we're going to go into. So if the market is to shift, like the title states, getting your investment properties a little bit cheaper, let's say that same piece of real estate is now $600. So it's $25,000 left. Not a huge amount off, but it's something. All the same numbers except your 20% down is now $120,000 instead of $125,000. So you're having to spend $5,000 less for deposit. So monthly $2,457 mortgage amount. Then with your strata and your tax, we're now looking at $2,847. So $2,847 to own it, $2,200 a month return. The loss is $647 a month. It's about $100 less loss a month for $25,000 less purchase price. Either way, you're at a loss every month, every year, just to hold the property. Obviously, no one has a crystal ball based on price. I'm going to say I believe that rents are going to stay the same or go up. I do not see them coming down anytime soon. I believe there's a lot more reality in pricing coming down, principal prices of real estate before the rental returns start coming down. My 2 cents. I don't have a crystal ball though. Those are two very common 20% down circumstances, and just that little variance shows $25,000 less purchase price. And this example is equal to $100 less loss a month. You're at a loss at either $750 or $650 a month. What we're seeing for the most part is that people are happy to take that loss because they're looking at real estate not by way of a cash flow, but by way of a principal growth circumstance. So they're banking that that $625 or that $600 is going to be worth more. So in the meantime, they are going to pay out of pocket in addition to the rent they're receiving just to break even for the duration of time they decide to hold it until they believe principal has gone up enough to make it worthwhile to sell this negatively cash flowing asset, we'll call it. Fine, now let's look at the other side. What would it take to buy this and be at a positive cash flow on this specific investment? So in this case, we need
45% down.
So for $625,000 purchase, 45% down, we need a down payment of $281,250. cash. That goes in. Our mortgage rate is now $1,760 a month. After taxes and strata fees, that turns into $2,150 a month. So we're positively cash flowing $50 a month after having to put 45% of the purchase price. So this is where we see the huge disconnect here in Vancouver, because if you've got over $250,000, is your option to buy a piece of Vancouver real estate for cash flow, only receive $50 a month. Now you're still susceptible, of course, to that capital appreciation or loss, no matter which way the market goes, and your belief on that. But if you're looking for cash flow to put down, again, just over $250,000 just to get $50 a month, up to you. May or may not be worth it. My experience with my clients, I'm not typically seeing people buying the real estate here in Vancouver and they're not looking at it that way, because the return is simply extremely minuscule. And I'd say all the investors I've been working with are looking at the capital appreciation, so they're willing to take the loss every month in hopes, we'll say, with the belief that the principal appreciation is going to go up more than they're losing every month. Everyone has a strategy. That gives you a little idea on not only what the adjusting of the monthlies are going to look like if the prices come down and we can start purchasing investment properties at cheaper prices in the current climate of the market, if that's the way it continues to go, but in addition to that, what this whole investment real estate paradox looks like by way of what's commonly done. That kind of maximum 20% down was pretty common. Obviously, a lot of people are putting a lot less than that just because the barrier to entry is so high on this price-wise, and what an actual positively by $50 a month cash flowing piece of Vancouver real estate can look like, and what that deposit looks like as well, which is clearly the barrier to entry for most. In addition to these things and these numbers, we always want to take into consideration building condition, picking a specialist realtor that knows what you're buying so they can be aware and very proactive to look into circumstances of the piece of real estate, what type of building it is, due to what year it was built, is stuff coming up for renewal or the assessments. All this sort of stuff is clearly going to weigh on that monthly cost that you're amortizing out over whatever term. The difference in rates, you go to the bank and say, I want to buy a principal residence, you're going to get a certain set of rates, and if you say, I want to go and buy an investment property, you're going to get a different set of rates. I'm going to leave it there. If you have any other questions on these details, please contact me direct, j@McInnesMarketing.com, 604-771-4606. Thank you again for watching as usual. Until next week, we hope you have a good one and look forward to being in touch. Bye.